Welcome to the early path to millionaire status. If you are in your early 20s with savings and no debt, you have a tremendous head start. In this video, we will turn that advantage into a concrete plan. We will focus on behavior, simplicity, and discipline, rather than complex trading. First, we will outline the plan. Then we will secure your foundation, master the best investment vehicle available, apply a straightforward strategy, and build mental fortitude to stay the course. Along the way, we will use diagrams, examples, and quick quizzes to help you internalize the concepts. Now let's quickly preview what's ahead. Here is the plan for the video. We will start with why simplicity wins. Next, we will cover Phase 1, building an emergency fund. Then, we will move to Phase 2, the Roth IRA. After that, we will implement a simple index fund strategy in Phase 3. We will then cultivate mental fortitude in Phase 4. We will also address the danger of lifestyle creep, build an action plan checklist, and review diagrams including a flowchart, a pie chart, and a timeline. Finally, we will test your knowledge with quick quizzes. With that roadmap in place, let's add a brief but important disclaimer. This content is educational and not individualized financial advice. U.S. rules, such as Roth IRA contribution limits and income thresholds, can change, so you should verify current regulations. Your situation may differ, and you should consider consulting a fiduciary-advisor who is obligated to act in your best interest. With that clear, let's move into the fundamentals and set your foundation. Why does simplicity win? First, behavior outperforms brilliance. Consistently automating your savings and investments outperforms sporadic manual decisions. Second, broad diversification, achieved through total market index funds or target date funds, reduces risk and eliminates the need to pick individual stocks. Third, time in the market is more important than timing the market. Staying invested allows compounding to do the heavy lifting. Fourth, costs matter. Low fees keep more of your returns compounding for you rather than being lost to expenses. With the philosophy set, let's secure your foundation. Phase 1 is all about safety. Set aside 3 to 6 months of essential living expenses. If your monthly spend is around $2,000, that means $6,000 to $12,000. A strong target is $10,000 to $15,000 in a high-yield savings account or a money market fund, where yields have recently been around 4%. The goal is to avoid taking on debt when life happens, whether it is a job loss, medical bill, or car repair. This is your sleep-at-night money. Once this foundation is in place, we can confidently move to the most powerful account for young earners. In Phase 2, we focus on the Roth IRA, an incredibly powerful account for young, low-income earners. You contribute after-tax dollars now, ideally when your tax rate is relatively low. And in retirement, your qualified withdrawals of both contributions and growth are tax-free. As of 2024, the contribution limit is $7,000, subject to earned income and income phase-out rules. Importantly, your contributions, though not earnings, can be withdrawn at any time tax and penalty-free, which adds some flexibility. Automating contributions each month helps you reach the annual limit without stress. Next, let's check your understanding with a quick quiz. Question: how much should you typically keep in an emergency fund before investing aggressively? Options: A. 1 month of expenses. B. 3 to 6 months of expenses. C. 12 months of expenses. D. No emergency fund is needed if you have a Roth IRA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 3 to 6 months of expenses. This range gives you the resilience to handle common emergencies without resorting to high-interest debt, and it allows you to keep your long-term investments intact during market volatility. With that settled, let's move to the simplest, most effective investment strategy inside your Roth IRA. Inside your Roth IRA, the simplest approach is often the best. Consider a total stock market index fund, or, for an all-in-one solution, a target date retirement fund that automatically adjusts asset allocation over time. Set your contribution rate around 15% of income and automate it. Reinvest dividends and avoid reacting to short-term headlines. Consistent buying through both rising and falling markets outperforms attempts to time entries and exits. Now, before we discuss mindset, let's visualize how each dollar of your paycheck might be allocated with a simple budget pie. This pie chart illustrates a minimalist budget that prioritizes investing early. Begin with approximately 15% toward investing, 50% to needs, 30% to wants, and a small buffer to smooth irregular expenses. As your income grows, increase the investing slice while keeping wants under control. This prevents lifestyle creep from eroding your future wealth. Next, to tie the plan together, let's outline the full journey in a flowchart and then discuss the mindset to withstand volatility. This flowchart maps the journey from setting an emergency fund to investing in a Roth IRA, selecting a total market or target date fund, automating contributions at around 15% of income, and reinvesting dividends. A decision node checks if you have the emergency fund. If not, you loop back to saving. Another decision node handles market drops. Rather than selling, you stay the course and continue contributions. Over time, this loop fuels compounding towards substantial wealth. With the roadmap visualized, let's build the mental strength to keep going when markets get bumpy. Markets will fall, sometimes sharply. That is normal and expected. The most damaging move is selling in a panic and missing the recovery. Broad indexing over long periods tends to smooth out volatility. With steady contributions and the historical returns of diversified equities, your money can potentially double over a decade, especially when you are contributing regularly. Focus on the habit of investing, not the day-to-day market value. Now, let's check your understanding of Roth IRA mechanics with a quick quiz. Question: which statement about a Roth IRA is most accurate for young, low-income earners? Options: A. You pay taxes later and withdrawals are taxable. B. You pay taxes now, and qualified withdrawals are tax-free. C. Contributions are locked and cannot be withdrawn before retirement. D. It requires complex stock picking to work. 2. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that you pay taxes now and qualified withdrawals are tax-free. That is the core advantage of the Roth structure for young earners. Contributions can also be withdrawn anytime tax and penalty-free, which adds flexibility. Next, let's translate strategy into specific, practical steps you can take this week. Here are 7 concrete steps. First, calculate 3 to 6 months of expenses and set a savings target. Second, place that cash in a high-yield savings account or a money market fund. Third, open a Roth IRA at a low-cost brokerage. Fourth, automate monthly transfers that, over the year, reach the contribution limit. Fifth, select a total market index fund or a target date fund that fits your timeline and risk tolerance. Sixth, enable dividend reinvestment. Seventh, every time your income increases, raise your contribution rate to accelerate compounding. To reinforce the numbers, let's look at a brief projection table. This table illustrates how steady $6,000 annual contributions can grow at an assumed 7% average annual return. After 10 years, the approximate balance reaches around $89,000. This is a simplified projection and not a guarantee. Actual returns will vary. But the example shows how discipline and time drive substantial growth. With numbers in mind, let's address lifestyle choices that make or break this plan. On the left, lifestyle creep shows up as car loans, frequent upgrades, and expensive brands. These choices raise fixed costs and reduce your ability to save and invest, causing your savings rate to stagnate or decline. On the right, minimalist living favors reliable used cars, durable basics, and infrequent upgrades. This keeps fixed costs low and increases flexibility, enabling your saving rate to rise as your income grows. This single behavioral difference compounds into dramatically different outcomes over time. Next, let's add a timeline diagram to visualize milestones on the journey. This timeline frames milestones on the path to significant wealth. You begin by contributing consistently each year while maintaining an emergency fund. Over the next several years, staying invested and avoiding lifestyle creep are crucial. As your skills and income grow, contributions can increase, accelerating compound growth. By the midterm, crossing 6 figures becomes a motivational milestone. And later, the compounding curve steepens. Patience, habit formation, and skill building are the levers that keep you on track. To cement the ideas, let's include a concise one-page plan in Markdown you can copy. Here is a concise one-page plan you can copy into your notes. It emphasizes building an emergency fund, automating Roth IRA contributions, selecting a total market or target date fund, reinvesting dividends, ignoring short-term noise, and increasing your savings rate with every raise. The guiding mantra is simple, brutal, and behavioral. For deeper learning, consider classic personal finance and investing books. To wrap up the main ideas, let's review the key points. Key takeaways. Build an emergency fund before investing aggressively. Maximize and automate your Roth IRA contributions. Use low-cost index funds to gain broad market exposure. Guard against lifestyle creep so you can raise your savings rate over time. Finally, stay invested and avoid emotional decisions. With the essentials fresh, let's summarize and point you toward next steps. In summary, your foundation is a cash buffer that prevents setbacks from turning into debt. Your primary investment vehicle is the Roth IRA, which offers tax-free growth when used correctly. Your strategy is to use low-cost index funds and automation to harness compounding. Your mindset is patience and discipline in the face of volatility. As a next step, verify current rules and consider consulting a fiduciary advisor to tailor this plan to your situation. As we close, I have one final request. Thank you for watching. If this video helped clarify your path, please like the video, share it with someone starting their journey, and subscribe for more practical, no-nonsense finance content. I would love to hear your questions and your one-page plan in the comments. Until next time, stay disciplined and keep compounding.